Hello, everyone. Today is Tuesday, July 15, 2025, and I'm Brian Tokuge, Portfolio Manager here at the Rice Partnership. Joining me today is our Chief Investment Officer, Orest Saikevych, who will be giving us his mid-year outlook. Thank you for joining us today, Orest.
Good morning again, Brian. Good morning, everyone.
So, at the halfway point of the year, where have you been so far, and where do you see the economy and the markets going in the second half of the year?
Okay, the year started out, the economy was growing at a decent pace. We had a little bit of give back from a very, very good Christmas season. People pulled back a little bit on spending, but later on started to spend again when the tariff impact started to hit. But overall, the economy was good. Markets were in a little bit of a correction phase, but the real big news happened on April 2nd, which was deemed Liberation Day, in which tariffs were imposed on most countries. Most economists had expected tariffs, but not to the extent that we saw there. The average tariff rate went up from 2.5% to about 26 to 28%, a huge jump. And subsequently, the financial markets did not like that. Equity, fixed income, and the US dollar all fell. That's pretty rare for all three of them to fall. Usually, when stocks fall, you get a safe haven demand bid into bonds and also the dollar. It didn't happen this time, and it was a bit concerning. And after about a week or so of declines, the White House abruptly shifted course and announced that tariffs would be delayed for 3 months to allow individual countries to negotiate terms with the U.S. And since then, we've had some progress there. China overall, we have a general agreement. Details still have to be worked out. The UK also, and finally Vietnam. And there are other countries that we're working on right now. The EU, India. The president has threatened tariffs for Japan, South Korea, Canada, and Mexico, and the EU if there are no agreements reached by the first. But at any rate, we do expect to see at least two or three more agreements by then. So overall, tariff news is fluid. It continues, and we'll have to watch that closely. A lot of what will go on with the economy depends on what happens with tariffs. Another very, very big item that was out there was the tax bill. And the tax bill was passed much earlier than expected. We thought we would probably see an August uh, timeline for it. Fortunately, we got it done by the 4th of July, and that's good because it increases certainty as far as consumer spending, corporate spending is concerned. Also, the debt ceiling was pushed out at least a year, so that is not going to be an issue for everyone. Uh, then the deregulation process is continuing, and we saw the major banks have more capital freed up for lending, dividend increases, and share buybacks. That should be a plus for the economy. Also, the deregulation may help as far as freeing up government lands for additional oil exploration and also rare earth minerals exploration, which is a plus. Uh, as far as the economy right now, we're seeing some distortion as far as consumer spending is concerned because of the fact that with the tariff news, a lot of people decided to hoard ahead of time before increases. So They bought more in the spring, and then, now in the summer, are pulling back. Also, CapEx, corporate spending, you saw a lot of companies hoard, add to inventories. There's going to have to be a destocking there. So as far as a signal for the economy by the consumer, it's going to be distorted. I think a clearer indicator for the economy right now is the labor market, which is tepid, but it's not weakening significantly. I think what we have to keep in mind, especially as far as the weekly jobless claims numbers, is that employers are not aggressively hiring, but they're not firing workers either. And a lot of CEOs remember the post-COVID environment where corporations, after initially laying off people, and then we got these fiscal stimulus and they wanted to rehire them back again. A lot of the people they didn't come back, and they had a supply of labor shortage. So they're hesitant about firing people. So the job market, as I mentioned, it's not weak, but it's not strong. It's kind of middling right now. And if it continues that way, that'll be we should be able to get by with the economy. I will mention that probably the biggest surprise to everyone so far this year is the weakness in the U.S. dollar. Once again, even though a lot of people thought the dollar might be weak this year, they expected a correction of possibly 5%. We've seen at least a 10% correction with the possibility of another 10% downside, which really for a currency that's huge. So um, uh, there's a number of factors for it. I think foreign repatriation of assets after a lot of the tariffs were announced had a factor in it. Also, massive fiscal stimulus in the Eurozone, particularly in Germany. You're seeing the Germans basically kick out their fiscal break. Germany has historically run low budget deficits as opposed to a lot of the developed countries. And they basically decided to do away with the fiscal break. So now they're going to be able to spend more. They're going to have bigger budget deficits, but they have capacity for that. And they're spending, especially as far as defense spending, because a lot of concerns by the NATO countries about the commitment of the U.S. to help defend them in case of an attack, especially by Russia. So you're seeing more defense spending, and for the first time this century, you're seeing Europe really picking up as far as economic growth is concerned. And we see that as a multi-year phenomenon. It's not just a one-shot deal. Meanwhile, as far as the Fed is concerned, the Fed has been in the background with all this, all this news going on. We're still of the opinion that the Fed will cut once or twice this year, probably towards late in the year, mainly because the Fed wants to see the effects of the tariffs on inflation. Chair Powell is concerned about tariffs bleeding into inflation, causing inflation to rise. They want to see at least a couple more months of inflation data before they may want to start pulling the trigger. But for now, they're cautious and they're on the sideline. We do think, though, that they'll probably start moving late in the year. Getting back to tariffs, I mentioned that the tariffs had gotten up to 26 to 28% on Liberation Day. After that, they were pulled back. We think that, there are a lot of scenarios there because the situation is still fluid. I think right now you're looking at an average tariff rate of 13 to 15%. If things settle out, a pessimistic outcome would have the ATR around 18%. a more positive one would have it closer to 10. Right now, we're probably about halfway in there. So remains to be seen. We'll be watching developments in individual country tariffs very closely. As far as GDP growth, after the massive inventory and consumer spending distortions of earlier this year, where we had actually a print in the first quarter of slightly negative in GDP, we see GDP bouncing back to around 2.5% second quarter. And in the second half, due to contractionary effects as far as tariffs are concerned, we see the real GDP growth of about 1 to 1.5%. Inflation in terms of the Fed's favorite PCE indicator, we see that ticking up to around 3.5%. So, and then finally, as far as chances of a recession are concerned, we had ratcheted up the possibility of a recession to roughly a coin flip 50-50 on Liberation Day because of the massive changes in tariffs and what that might mean to the global economy. We brought that down to we're basically at around a 1/3 possibility, and that's more or less where we've been for most of the last couple of years. So we think that the U.S. economy will be able to muddle through as far as the tariffs and everything else is concerned. As far as changes to portfolios, we've added to international equities because of the reasons I've mentioned, in particular Europe, where we see more growth, and so we've added as there. With core equities, we've made a move back to some more AI or artificial intelligence plays because it appears that the DeepSeek threat to US AI has receded quite a bit. On the fixed income side, we've most recently made a switch for non-taxable accounts to an ETF from a mutual fund, which is less expensive. And also it has less exposure to longer maturity US Treasury debt. And we're concerned about longer term US Treasuries like 10, 20, and 30-year Treasuries because of the fiscal budget deficit, which it looks like the recent tax bill will add to rather than improve it, unless we get large increases in tariff revenue. We do expect a bump up, but we don't think it'll be enough right now. Time will tell, but for now, we're cautious and we're trying to avoid longer term US Treasury debt as much as possible. Finally, I'll just point out that even though we've come a long way, we've had a 20% drawdown in stocks in April because of Liberation Day, and then the aftermath where we came all the way back and we're at new highs. But over the last decade or so, that has turned out to be a rather common phenomenon. We had similar drawdowns in 2016, 2020, and 2022. And then soon thereafter, the market rose to all-time highs. Indeed, if you look at April 9th, which was a huge reversal day, the S&P was up almost 10% in one day. And usually 10% is on average what you get in a year. So time in the market is very important. And once again, it shows the value of being in the market and not trying to market time it. So overall, we were constructive on the markets and looking for more clarity as far as the tariff situation, which we think we'll have a lot more news to report on in the next few months. Thank you very much.
Well, that's about all the time we have today. Orest, thank you very much for your mid-year outlook. That was a lot of information and knowledge you shared, and we really appreciate that. And to everyone tuning, thank you for watching. Goodbye.
Bye. See you next time.